Top 10 changes for real estate investors under Biden's new tax laws. It seems to me like every day the average investor is in the crosshairs of big government. To me, it seems like ever since hedge fund money and institutional buyers came into the market, it seems like nowadays the government has decided to eliminate the small mom and pop investor from the equation altogether. I'm not even going to go into the eviction moratorium and how it has devastated the average investor. And we haven't even seen the repercussions of foreclosures coming our way because of that stunt they did. Now, you might be wondering how the new tax proposals from President Joe Biden could affect real estate investors, and I'm going to highlight the top 10 proposed tax changes that would affect both real estate investors and business owners according to the Biden tax plan. So here's the overview. Joe Biden has proposed to eliminate many components of former President Donald Trump's tax plans. President Trump created tax reform to help stimulate the economy by reducing corporate tax rates and providing additional tax incentives to real estate investors and businesses. Now, with the possible reversal of this tax reform and other proposed changes, this could affect everything. Let's uncover the potential real estate implications that will actually affect you if this goes through. Now I'm going to go over the top 10 changes for real estate investors, and the final and last one may be the biggest of them all. And do me a favor, as I'm going through these, make sure you leave me a comment and let me know if any of these have actually affected you yet, or if you think it may affect you in the future. Number 1, elimination of bonus depreciation. This is a tax incentive that allows a business or real estate investor to immediately deduct a large percentage of the purchase price of eligible assets, rather than them be able to write them off over the useful life of that asset. For example, a real estate property improvement like landscaping and have a depreciation period of, let's say, 15 years and qualify for bonus depreciation. If you spend $10,000 on landscaping improvements for a rental property, you can use this bonus depreciation to deduct the entire cost in the year that you spend the money. Other items that may qualify for bonus depreciation include the purchase of furniture, appliances, and other real estate improvements. Number 2, elimination of the 1031 tax exchange. A 1031 exchange is a swap of investment property or other properties that follows the capital gains tax, and it can be deferred. This is a popular real estate strategy that has been in place since 1921. Number 3, raising long-term capital gains tax rates for high-income earners. Long-term capital gains tax would increase for those earning over $1 million a year, taxed at regular earned income rates rather than long-term capital gain rates. As it stands right now, the top tax bracket for long-term capital gains is 23.8% if you include the NITT, which is the net investment income tax. This is 3%, which is applicable to high-income earners. Biden has proposed raising the long-term capital gains bracket to 43% for those earning over $1 million a year. Number 4, elimination of the step-up basis. This is essentially a death tax. Let's say that your parents bought a house in 1970 and they paid $50,000 for it. And today the house is worth $500,000. If your parents were to pass away and leave you the sole beneficiary of the house, there is a step-up basis law which is allowing the original cost base of $50,000 to step up to today's full market value for tax purposes of $500,000. If you were to sell the house the next day for $500,000, there would be no tax due on the $450,000 gain. Under Biden's tax proposal, this step-up basis would be eliminated, and therefore you would be responsible for the tax due on that $450,000. Number 5, implement a $15,000 first-time homebuyer tax credit in 2008. The Housing and Economic Recovery Act sought to encourage Americans to purchase homes by creating a tax credit worth $7,500 for first-time buyers. The next year, Congress increased that amount to $8,000. The purpose was to encourage home ownership and stimulate the U.S. housing market during the Great Recession. Biden has proposed a similar plan, but would nearly double the tax credit amount. This time, the purpose would be to allow affordability and accessibility to first-time homebuyers rather than stimulate the housing market. Number 6, phase out a QBI, qualified business income deduction. For income earners making over $400,000, QBI allows eligible self-employed and small business owners to deduct up to 20% of their qualified business income on their taxes. This could affect a large number of real estate projects and businesses if this goes through. Number 7, reduce the estate tax exemption from $11.8 million to $5 million. The Tax Cuts and the Jobs Act doubled the estate tax exemption to $11.18 million for individuals and $22.36 for married couples. This means a person can pass away with $11.18 million in assets and not have to make an estate tax payment. Biden has proposed that this be reduced to $5 million, which would largely affect people who own assets, including real estate and their businesses. Number 8. Raise corporate tax rates to 28% from the current 21% level. Starting in 2018, the tax law radically cut the corporate tax rate paid by C corporations from 35% down to 21%. There's also a proposed 15% minimum tax for corporations with profits of $100 million or higher. This minimum tax is structured as an alternative minimum tax. Corporations would pay the greater of the regular corporate income tax or the 15% minimum tax. Note that the net operating loss or NOL and foreign tax credits would still apply. This change would primarily affect publicly traded companies, but also will affect some real estate businesses and will affect your bottom dollar. Number 9. Raise the top federal income tax bracket back to 39.6% from 37%. This would affect income earners who earn over $400,000 a year. Though this is not directly tied to real estate, however, many accredited real estate investors are high income earners, and this could affect them if this changes. And number 10, Social Security tax increase for high income earners. As it stands today, the 12.4% Social Security tax stops kicking in once you earn more than $137,700 per year. The Biden proposal would have this tax kickback for any income earned up to $400,000. Though this does not directly tie to real estate, many accredited real estate investors are high income earners, and this could be affecting them with the change. And as you can see, some of these tax implications may or may not affect you directly. But one thing I can assure you is that if you stop or slow down the momentum of the market, it will seize up at all levels. Especially remember that everything is connected, especially in real estate. Just because you make the money doesn't mean you're able to keep that money. Remember that having a strong team means having people help you with both tax savings as well as asset protection. So make sure that you add them to your team early on in your investing career because they are vital to your success. I'm Steve Rozenberg. Please leave a message or comment if any of these have affected you or if you think that they will affect you in the future. Talk to you later.